Hello and good afternoon, everybody. Thank you to everybody who has dialed in and joined us for our second Risk Pulse at Riskworx. We are busy looking at the private credit bubble, and I would like to introduce our team, which includes Gary and Leila and Benjamin, who will be taking us through a South African lens of the private credit bubble. Thank you so much to our team. Should you have any questions during the course of the presentation, please be sure to make a note of it in the chat, and we will address it either at the time or come back to the question at the end. But you are more than welcome to engage with the team on the subject at the end. Thank you so much. Thank you to the team. Go ahead.
Right. Are we on? Good afternoon, everyone. So thank you for that, Jenny. We're going to be talking about the private credit bubble, which is currently arising in South Africa. It's not entirely a new thing. You'll see some slides a bit later, but we're going to be looking at the global experience of this private credit bubble. We'll be explaining what it is, what the problems could be for South Africa because of the experience globally. So it does have a South African lens sort of shot to this. We are looking locally and what consequences could evolve from this. So without further ado, I'm going to move on. We're going to share the presentation. So I'll start off here. So first of all, what is private credit, right? And it is what it says on the tin. It's private credit, which is not. It's credit ratings, it's credit assessments, credit opinions, and so on that are assigned to issuers, not by the big ratings like Fitch and Moody's and S&P, right? So hopefully, if you're hearing that for the first time, you're already getting a little bit nervous because I mean, not that after the credit crisis, the main rating agencies were thrown into a little bit of disrepute. But I worked for Fitch for many years, and I can tell you, I think they do reasonably good jobs, right? I mean, it's a process, there's a committee, there's a whole, they've got over 100 years of rating experience, default experience now. So, they're well established, whatever you may think of them. There's a process and they have to be accredited and they're validated. There's a rating agent, there's a rating for rating agencies, right? They are scrutinized. Whereas if it's just private credit, by definition, it's just, it's private credit. So going from left to right now, so private credit has exploded across globally, right? It's coming a little bit later to South Africa, but that may not be a bad thing because we can learn from global experience. It's a multi-trillion-dollar asset class, and there's a lot of senior figures, people that are well versed in the industry that have been warning and have warned. You'll see, we'll talk about local experience as well, but also what's happened globally, that the plumbing has not kept up in the sense that the whole rating process, etc., hasn't kept up. This is often a thing. I'm not going to go on about the credit crisis too much, but those of us who remember it, who were there, you'll remember that it was, things were exploding globally. There was all these new products and CDOs and CPDOs and all sorts of weird things. And rating agencies were not necessarily keeping up. The regulator wasn't necessarily keeping up. That's what happens, right? There's innovation and, places don't always, the mathematics doesn't always keep up with what's going on in the world. And that's a bad thing, right? And that's certainly one of what's happening in the private credit bubble problem. So the mechanism, going to panel 2 there, is essentially that the insurer shops, or the issuer shops for a generous private credit letter rating to lower capital charges. We'll talk about that on the next slide. But and if said issuer, well, not the issuer, the private credit issuer of the one who issues the credit rating, if they are less than scrupulous, I mean, because these things can be. A lot of money can be charged, right, for a credit opinion or a credit rating and so on. And if they're private, by definition, not necessarily any company, but I mean, it's a private thing. You don't have to go to the big four. And so you can get the situation where if an issuer doesn't like their rating that's been issued, they just move on to the next one, right? It's like if you go to a doctor and you don't like his diagnosis, you go for a second opinion. It's not quite the same, but You get the picture, right? So, and I'm sure you could see that there is horrible conflicts of interest there, right? Because there's a lot of money involved. So issuers of credit ratings can be, there's an incentive, let's say, I'm not implying anything, but there is an incentive to give the right credit rating, right? Whatever it is, let's say a more generous credit rating than could possibly be warranted. And so then there's the South African microcosm, which we'll talk about later in more detail, which is Enable Capital. And I'm not going to go into too much details about it because we cover it a little bit later. It's 1.5 years old, so it's a recent event. And there was some 700 million taken from top institutions. So companies, I mean, it's easy to criticize in hindsight, but they should have known better. But I mean, this is the bubble. It's not the bubble bursting, but it's certainly the bubble expanding, and we can learn some lessons from Enable Capital. That's a local South African experience. We will also be talking a little bit about global experience, what's happened there. And so moving on to the last panel there. Our failure mode, if you want to call it that, it's not necessarily inflated ratings. So it could actually be that, and it could certainly evolve to that, right? Where ratings are artificially inflated because, as I said, unscrupulous rating issuers, they want to get paid, right? So they're prepared to, lower the PD and raise the rating to satisfy their clients. That could evolve into that, and I'm not at all saying, I mean, maybe happening already. But at this stage, that our failure mode in South Africa is more opacity, right? It's an opaque market. You can't see where a credit rating is, a private credit rating. How did they arrive at that figure, right? If you were, and I'm not making an endorsement here for Fitch and Moody's, but if companies were forced to use, the big three, Moody's and S&P and Fitch, they've got a very transparent rating system, right? And it's out on the web. Once the issuer is paid for the rating, all that process, the rating report, etc. It's very transparent. It's there for everyone to see. It's not concealed, right? Whereas these private credit ratings are opaque and there's not great verification. Which of course you can see is there's going to be an issue there. If you can't see behind the curtain, how on earth was this credit rating arrived at? And it's a very fast-growing retail channel, which we'll also talk about a little bit later. So just quickly to give you an idea of the global massive increase globally, you can see it's almost exponential there from about 2014, and the three institutional, retail, and insurance. But just looking at that exponential rise there up to last year, you can see it's grown from small numbers to like 2.6 trillion US dollars. It's a non-negligible asset class as well. So the growth has been ridiculous, and it's still continuing apace. And that's always a problem, right? I wouldn't necessarily call that a bubble, but it's inflating at a great rate, which by definition is a bubble. So just a little bit of further background. Why this drive for inflated credit ratings? Why this need for a better credit rating and a lower PD? And those of you who work in regulatory capital or just credit risk will recognize that the famous Basel formula there, the Vasicek formula. I'm not going to bore you with all that mathematics so late on a Wednesday afternoon, but I will say color-coded, right? These are the levers you could pull. So if you wanted to reduce your capital, that's what the K stands for. This I don't know if you can see the mouse, but on the left-hand side of the formula, the capital there given by the capital K, if you're a bank, your capital is determined by that number there, right? That's the number you should keep back for regulatory credit risk capital. But what about regulatory risk capital? I mean, that is a measure. That's what Basel uses, fair enough. But that is the measure of how you calculate, your credit risk. So any institution, bank or not, I know they could be using other models, but it's basically this model, right? And these are the levers they could pull to reduce their credit risk. They could reduce their exposure. I'm going to go into laser pointer. They could reduce their exposure, right? I mean, that's the obvious thing. They could also find better deals, right, and reduce their loss given default. Generally, that's very difficult to do. You don't really know. Loss given default's a difficult metric, etc. We could reduce the asset correlation here between the borrower and but that's also under Basel, that's mandated. You don't have a choice. You could reduce the maturity of the instruments, but these are difficult levers to pull. It's not easy to just go and change or find borrowers with better loss given defaults, etc. And you can see here the probability of default. I mean, it's just in the formula. It's a dominant thing. Again, those of you in credit risk will know that PD is embedded in this B over here, and the PD is embedded in the correlation. I mean, the PD is a very dominant sort of variable in this equation. You pull that lever, and you can significantly alter your credit risk. So, I mean, obviously, your default rate, your PD, is a huge driver of credit risk. And that's the problem, right? Is that's the easiest lever to pull. It's the most obvious one. And what happens if you do pull it, right? So just, oh, sorry, I'm in presentation mode. Okay, so just looking at, I forget where I got this from. This is a sort of standard credit rating, grade versus PD. I think this won't be from Moody's. It's either from Fitch or S&P fairly recently, right? And there's the associated PDs, or not default rates, but the PDs. And you can see, right, obviously, as the grade gets worse, going down the scales here, you can see the PD gets proportionately worse. I mean, that's fairly obvious. But just to plot that, and it's the same graph, by the way. I've just split it into two axes. So these are the triple A's to the double B's, the left-hand panel, and the right-hand panel is the double B to the C, and they're on different scales. So I didn't want to wash out the effect, hence I drew them on separate graphs. And you can see the blue line is the probability of default plotted off this panel on the left there. And capital, the associated capital, let's call it credit risk, is the red line, right? And you can see it drops precipitously. So let's say you were a triple B, right? I'm just going to use that as an example. And you had that PD, and that's your level of capital. That's on the right-hand axis, right? These are color-coded. So you can see whatever the regulatory capital is, 1.6 units, whatever your units are. But if you move from a triple B, just one grade down, I mean, you can see that proportionate decrease in credit risk is enormous. And that's the better grades, right? So, if you can approach, if you're a credit risk, private credit risk seeker, a rating seeker, and you find a generous awarder of credit ratings, and you can persuade them to nudge, your rating probably where it shouldn't be, you can see the incentive, right? The amount of capital saved, well, the amount of credit risk decrease, the reduction in credit risk is enormous. It's not some marginal little decrease. It is substantial, right? It's better than exponential, I would say. You can see, and then similarly for the worst ratings, if you get a B minus or from a C to a B minus, I mean, look at that. You're going from 25 to 5. Actually, I'm looking at the capital. Sorry, you're going from like 30 to 18. I mean, it's a huge decrease. Reduction in credit risk. So that's where the incentive is. Better credit ratings, you reduce your credit risk if you believe the credit rating. That's implicit in my comment. And you can see what the incentive is. So that's the background, and I'll now hand over to my colleague.
Right, thanks so much, Gary. To start off with from my side, I think it's important to first address what the global private credit setup looks like. So starting with defining and illustrating the use of private credit, exploring the boom of the asset class, as Gary was showing earlier, and really developing an understanding of how we've arrived at the precipice of a crisis, which is a crisis we're more likely than not to fall into if regulatory reform doesn't happen and doesn't happen soon. So just to start off with, what is private credit? As Gary said, it's all in the name, really. It's lending done privately. And I think it's useful to contrast private credit to the more traditional forms of credit that we're familiar with. So traditional bank loans, for instance. So private credit is debt financing, which is provided by non-bank lenders. And the capital then originates from investment funds, which is a clear contrast to a loan provided by a bank, because the loans originate from the deposits that depositors place at the bank. So it all sort of falls within one entity. But private credit, we essentially have a facilitator of the loan and then the person providing that capital. Private credit is quite nice for the borrower because the lender and the borrower negotiate terms one-on-one. So you can really tailor loans to specific idiosyncrasies of a borrower, which is often not the case in more standardized traditional bank loans. An unfortunate byproduct of private credit, like the structure, is that it falls outside regulated banks and public bond markets. So there's no enforced regulatory stress testing, no leverage caps, and there's very lax underwriting standards often because no regulation is enforced in that regard. Another thing that distinguishes private credit from traditional credit is that the underlying loans are typically held to maturity for a period of typically around 7 to 10 years, which is obviously different from traditional loans, which are frequently traded, so they're highly liquid, and market sentiment regarding the creditworthiness of the underlying loans is thus reflected on a daily basis. With private credit, the deteriorating credit quality stays hidden until it crystallizes in default, which obviously makes it quite a risky asset class then. So to summarize, private credit is bank-style lending without bank-style disclosure or capital rules and no daily pricing. So this slide shows the exact structure of private credit. So in the middle, we have our private lenders. So they fill the gap where banks fail particular borrowers. Now, these borrowers are typically smaller, opaque, or highly leveraged companies. So the thinking is that smaller companies struggle to raise capital in public bond markets because they don't need that much capital in the first place. So it's a whole long process for not that much reward. More opaque companies often require additional due diligence that banks aren't willing to perform. Now, whether these dedicated private lenders perform that due diligence is a whole other question, but the idea is that they do. And then, of course, highly leveraged companies. So banks are prohibited from lending to highly leveraged companies because of regulatory requirements. But just because your company is highly leveraged isn't indicative of an unhealthy business. So private lenders essentially make capital available to borrowers who wouldn't otherwise have access to credit. And they do charge a fee for making this capital accessible. And the borrowers are sort of caught between a rock and a hard place. So they're willing to take out this more expensive credit because they wouldn't have any other credit options otherwise. So how it works is the loans are issued by the private lenders, and then obviously your interest and capital repayment is made along with the service premium that is paid to the private lenders. Now, the key distinction with traditional lending is that we have our capital providers. So the most common of these are pension funds who seek high yields. So they would look to invest in a more risky asset, which has to then obviously compensate the investor with additional returns. Insurers also like making use of private credit because they can use it to match their long-dated liabilities because the underlying loans are held to maturity. So those 7 to 10-year liabilities are matched quite nicely. And then private credit has also started being made available to retail investors through business development companies. So that means people like me and you can invest as well. Now, this model might look good and well at the outset because your investors are being rewarded for the risk they take on. So the returns are directly correlated to the health of the underlying loan book. If there's a massive macroeconomic shock and many people default on the loans, the returns will be lower. But if everything is good and well, your returns should be reflective of a more risky asset class. The key issue, though, is a real opacity problem. So the private lenders aren't required by any regulatory standard to disclose any information. So they do typically make some information available to their investors, but very limited public information, if any. And even when they make this information available to their capital providers, it's often on an aggregate basis and at the private lender's discretion. So it's very difficult for the investor to perform independent verification of the health of the underlying loan book, which, yes, makes PD and expected credit loss calculations very difficult. So the issue really just boils down to an opacity problem and not the structure of the asset class itself. Now, I know it might be a little bit abstract to think of your life insurer or your pension fund investing in private credit, and maybe you yourself haven't actively had to do with it, but there's a really tangible way in which we've all been exposed to private credit. So I present to you the average Joe. That's just a random person off the street. It's me and you. So if you've ever made an online payment, it's likely that you would have seen a button at the bottom which says pay in full. So it splits your, say, 2,000 Rand purchase into 4 installments. So it'd be 500 Rand plus some interest. And this is known as a buy now, pay later scheme, which again is quite nice for the borrower because it allows the normal consumer to smooth their monthly spending. Maybe 2,000 Rand is a lot of money for you to be spending in a particular month, and you would just prefer to have a more predictable outflow of cash over a longer period of time. But the issue arises with where the money comes from. So there's been a huge surge in something called a forward flow deal, which is where an investor, so a pension fund or insurer, will provide a huge amount of money upfront, so say $1 billion, to some buy now, pay later scheme, in order for the buy now, pay later scheme to issue loans for some set period, say 6 months. But obviously, in granting this money upfront, there's no guarantee as to the quality of the underlying loan, which is a real problem because the risk is shifted from the buy now, pay later scheme directly to their investors, which is an issue because how much underwriting is there really on an online payment? And worryingly, 47% of buy now, pay later users have reported late payments or not paying at all. So it really is an incredibly high risk investment, and this isn't always reflected to the investors who are providing the funding. So if this opaque credit product is ringing alarm bells for you, it's likely because it's reminding you of the 2007-2008 global financial crisis, as Gary is mentioning. So it's unfamiliar, opaque products, and ratings arbitrage, as Gary mentioned as well, is a typical issue. So it's very similar to what was happening during the subprime crisis. I think Colm Keller, the chairman of the UBA, says it best when he says, I think regulators lost control because of their desire to over-regulate the banking system. They chased a huge amount of product out of the banking system and into the shadow banking sector, which isn't regulated on the same basis. So it's very sad, really, because these regulations were put in place to protect consumers and active members of the economy from another global financial crisis. And instead of mitigating that risk, it's really just shifted everything completely into an unregulated shadow space over which we have even less control, making it a particularly dangerous situation. So we can just get an idea of the global surge. So Gary showed that exponential graph at the beginning, but global private credit assets under management are forecasted to increase by a staggering 53% to $4 trillion by 2029. So it really is a big problem if we don't step in and take regulatory action, because $4 trillion just being allowed to float around without any regulatory oversight is obviously a key issue. And I think one of the particular cases in which it's a big problem is within US life insurers. So you'll see 10 years ago, 22% of US life insurance assets were in private debt, which is already quite a large amount. But these days it's at a third of their assets, which is incredibly risky. So as Gary was saying earlier, there's a lot of ratings arbitrage. And the reason it's such a prevalent issue in the US is because US life insurance regulation is notoriously lax. So there's no federal regulation. States can sort of do as they please. So there's that capital incentive because insurers need to hold less regulatory capital against investment grade assets. And that obviously frees up quite a bit of cash for profit-making activities. So this sort of incentivizes private credit funds to get as highly rated as possible. And as Gary mentioned, there's that conflict of interest because many US states make no distinction between whether your rating was from a small mom and pop shop or whether it's by Fitch, for instance. So it's basically a no-brainer for the life insurers to approach these smaller rating agencies who then compete with each other based on the generosity and the price of the ratings they issue. And the implication is that below investment grade risk gets carried at investment grade capital cost, which could cause very big liquidity problems if anything were to happen. So just to give you a quantitative idea of how bad this problem is, so there's an average gap of 2.7 notches between larger rating agencies and smaller rating agencies, and 80% of re-ratings, when they were done by a smaller firm, resulted in upgrades, with only 4% resulting in a downgrade. One particularly prolific rating agency was Egan-Jones, who in 2024 performed more than 3,000 ratings while only having 20 analysts. So you can just think the level of due diligence that's being conducted there. It's really staggering if you're looking at a large private credit fund. You can't do that in 2 days. So very, very worrying. So it's clear that lots of different authorities are responding to this problem. So we've seen the UBS and US regulators are also trying to curb these private letter ratings after Egan-Jones came under SEC investigation. But the International Monetary Fund is also taking notice. So its stability report in April of 2024 named private credit's fragile borrowers, layered leverage, and stale valuations as a risk that could turn systemic. And then the Financial Stability Board earlier this year coordinated its first global assessment and flagged valuation capacity, hidden leverage, and growing bank interconnections as key problems. So it's clear that the world standard setters are watching, and South Africa is keeping an eye out too.
So the real gunshot with regards to private credit in South Africa is Enable Capital and what happened with them. So let's go next by taking a deeper look at that whole debacle. Sorry, guys. The system we've set up. There we go. So Enable Capital was an SMME invoice financing lender led by Ruben Oliphant that was placed in business arrest on the 19th of November 2024 amid alleged misappropriation of funds. Total institutional exposure was more than 700 million rand. The Public Investment Corporation, Old Mutual, Sanlam, and SA Investments were all exposed, with the largest single disclosed exposure being Old Mutual at 150 million rand. Money which is now in large part entirely gone. So the PIC invested roughly 100 million rand in September 2024, and those funds allegedly vanished within 5 days. Old Mutual Alternative Investments held about 150 million rand through its hybrid equity fund, dating back to April 2023. Sanlam Investments had around 100 million rand in senior secured funding, and SA Investments has placed its exposure at 120 million rand or more in its affidavit. Other firms, including Prescient, Westbrook, and Mason Global, were also exposed, but declined to disclose their amounts. It's worth discussing, though, how something like this was allowed to happen in the first place, and we have narrowed it down to a few key pathologies. The first of which being no ratings. There is no record anywhere, not in the original Old Mutual announcements, not in any press reportings, not in the forensic findings of Enable Capital ever holding a credit rating from GCR, S&P, Moody's, or any other agency for that matter. Sophisticated institutional investors committed hundreds of millions of rands to an unrated, privately held lender. In the global private credit story we described in part 1, the problem was ratings that were inflated by small agencies competing in generosity. In this case, we didn't even get that far. There wasn't even a rating to start with. The second pathology is no independent verification of the underlying invoice book. The BDO Advisory Services forensic report, completed in June 2025, found that Enable Capital's executives had manipulated the very records investors were relying on. Inaccurate debtor aging reports, reclassified historic payments, and manual alterations to portfolio management sheets with no audit trail. The company was mandated to advance funds against verified invoices. Instead, significant capital was diverted to related construction entities, with approximately 108 million rand flowing to one counterparty with minimal supporting documentation. Nobody on the investor side independently checked whether the invoices were real, current, or correctly valued. The verification that should have been the cornerstone of the whole structure simply did not happen. The third is due diligence that was pledged but not upheld and then entirely concealed. The April 2023 Old Mutual announcement tells all here. It's a warm, detailed press release about infrastructure, community impact, and job creation, And it also explicitly commits Old Mutual to contributing governance and human resources and formalizing ESG data collection analysis and continuous monitoring. You can hear in how it's written, those are not vague promises. They are specific on-the-record commitments, and the money disappeared anyway. When the collapse came, that same announcement was reportedly deleted. Sanlam discloses exposure only under sustained press pressure. These are clearly not the actions of institutions that are comfortable with their due diligence record. And the worst part is that these losses don't sit in a vacuum, they get passed on. The PIC is the country's largest asset manager, investing on behalf of the government employees' pension fund. A loss at the PIC is ultimately borne by public servants' retirement savings. The problem, in the end, reduces to a simple equation. You take unrated, illiquid, privately held credits, you add institutional yield hunger and remove independent verification, and the result is money disappearing, with everyone catching on only once it is far too late. So that's what happened with enabled capital. But I think it's worth having a deeper look at South Africa's relationship with private credit in general. The first question is, why is private credit growing in South Africa at all? And the root cause is ultimately bank retreats. Under Basel III capital pressure, banks have pulled back from the mid-market. The SMME share of South African bank lending fell from about 28% in 2010 to about 12% in 2020, a relative decline of more than half. SMMEs still need funding, so the question is where they get it. And increasingly, that answer is becoming private credits. There's a real financing gap to fill, estimated at roughly $30 billion for South African SMEs, and private credit is rushing into it. That means a large pool of capital flowing from riskier sources to riskier destinations. As that pool grows, naturally, so does the risk attached to it. You can see in the two graphs here that massive funding gap just waiting to be filled. You can also see, however, in the second graph, that massive decrease in private equity fundraising. That's a sign that actually brings us to our next point. And that is that we are still early cycle. And that's the key point. The bubble, if it is forming in South Africa, is still in the growth stage, and we are early. In the private equity world, private credit is only about a 6% slice of the industry's 233 billion rand funds under management in South Africa. The kicker is intent. 86% of Southern African private equity firms now say they favor private credit as a diversification strategy, up sharply from 50% a year earlier. And 40% of allocators plan to increase their credit allocation further, with none planning to decrease it. If a private credit bubble does form in South Africa, it's in the pipeline, not yet in stock, but the enthusiasm is clearly there and the capital is largely undeployed. Private equity fundraising actually fell about 70% in 2024 to 8.4 billion rand from 28.1 billion rand. So what we're seeing is appetites and not yet real deployment. That early cycle position, however, is an advantage for South Africa. South Africa has tended to adopt these products late, which usually leaves us underprepared when a global failure may arise. But this time, being late is actually a gift. Capital is still queuing to enter, which gives us time to study the documented failure modes from the US, the UK, and the EU. And we can install best practice controls before the capital floods in rather than after. The usual weakness of slow adoption becomes an opportunity for preparation. In short, we get to read the answers before the exam.
Right, so I'm sure you now have a pretty good idea of the potential catastrophic impact of the private credit bubble and just what exactly its scale is, both locally and globally. But now our aim is to provide an overview of the shortcomings of our current regulations here in South Africa, and to provide some actionable insight as to how private credit providers and fund managers should proceed.
So it's worth pausing on one channel in particular, the one that turns insurers into such heavy buyers of private credit in the United States. That channel, as we discussed earlier, is ratings arbitrage, and the good news is that it barely exists here in South Africa. In the USA, insurance is supervised state by state, with more than 50 separate regimes loosely coordinated by the National Association of Insurance Commissioners. There is no single federal insurance regulator. And under that system, a rating from any registered agency maps straight through to capital. A AAA rating is a AAA rating, whether it comes from Fitch or from a 10-person shop competing for the business. Predictably, that invites generosity. Small agencies issue inflated ratings, and insurers get capital relief on assets that are riskier than the label suggests. South Africa doesn't work that way. We have a single prudential supervisor, the Prudential Authority, and it runs a Solvency II style standard formula that recognizes only a short list of registered agencies, those being the global big three, alongside local names like GCR and others registered under the Credit Rating Services Act. Crucially, unrated private loans attract punitive capital charges. Generosity simply isn't on the menu in South Africa. So the bottom line is this. On the insurance side, our regime is structurally more resistant to ratings arbitrage than the American one, and that specific mechanism is largely absent here. There still exists, however, a potential blind spot in pension funds.
Thanks, Ben. So since we're not directly exposed to ratings arbitrage, it doesn't mean we haven't escaped the brunt of the private credit issue. So as Ben said, our pension funds are particularly vulnerable, and that's because they need to adhere to Regulation 28, which is a limits-based, not risk-based regulation. So Regulation 28 stipulates that pension funds may hold up to 15% of their assets in private debt, but no specification is made as to the quality of that debt. So it could be an enabled capital sort of situation where you are investing in something that is underlying the absolute garbage. Now, obviously, if you have a prudent fund manager, they probably wouldn't hit this upper limit of 15% or would really try to do as much due diligence as is possible with their private credit investment. However, the onus shouldn't be on you as someone who holds an investment in a pension fund to make sure that the fund manager is looking after your money properly. There should be regulatory oversight that ensures this. Another huge issue is our fast-growing retail and wealth platform, because private credit is marketed and sold on retail and wealth platforms as a highly liquid asset where you could exit your position within a day. Now, we know this is obviously untrue because the loans underlying are held to maturity. So if there is some big macroeconomic shock which causes many people to default on their loans, investors will try to exit their position, but there's not enough liquidity to allow them to exit, which could cause catastrophic losses and is a real risk.
So after all of this, I think one big question still remains, and that is South Africa actually exposed if a private credit bubble bursts in the United States? We believe a direct hit is unlikely, as our domestic funds are smaller, simpler, and more conservatively structured. And tellingly, several of the problem children of US private credit are largely absent from our market. You can take payment in kind structures, for example. These let a borrower pay interest, not in cash, but by piling on more debt. Lenders love the headline yields, but a distressed borrower is really just compounding the problem while dodging failure for a little bit. Exposure at default keeps growing and keeps growing. Rising payment in kind usage tends to be one of the clearest signs of credit stress building quietly beneath the surface, but thankfully we largely lack them here in South Africa. We also lack perpetual BDCs, which are an American vehicle that pulls retail and institutional money into direct lending portfolios with no fixed end dates, while still promising periodic redemptions. That's an inherent liquidity mismatch, which is fine in calm markets, but when everyone heads for the exit at once, redemptions get gated or blocked. Then there are private credit CLOs, which pool loans and slice them into tranches, adding leverage and interconnection, which is exactly the kind of plumbing that lets a local problem cascade into a systemic one. And our private credit firms also simply don't carry the same heavy concentration in software and tech lending as the United States does. Given how fast that industry has risen and how much the hype around AI is clouding the underlying economics and valuations, those concentrated bets are a real vulnerability, because a single re-rating or disruption can change the entire picture overnight. So if there is any spillover, it will be second order. Because our direct exposure is limited, the risk reaches us less through credit or counterparty losses and more through the macroeconomy. Higher global risk premium, tighter financial conditions, and knock-on effects on asset prices and capital flows. The Rand is a favorite liquid proxy for emerging market risk, so it tends to move far more than local news or loan justify. South African government bond spreads can widen in sympathy even when nothing has actually gone wrong at home. And that's the mechanism to watch. That is how a US-specific private credit shock is most likely to reach us. And I'm going to hand over back to Gary.
Right, thanks everyone. So before we talk about these guardrails, just to point out, we don't. It's not Riskworx's position to be a Cassandra, right? The prophet of doom, and say, you know, the end of the world is coming. Because as my colleagues have pointed out, it may not be that bad yet, but that's no excuse not to learn from experience and prepare, right? Those of you, again, who are young enough to remember the credit crisis will remember, I mean, it was exploding all around the world. South Africa largely escaped. We escaped the worst of it anyway, and that was good prudential regulations, etc., etc. And we had the one of the King Acts, which said, you know, CEOs and whatever, there has to be some skin in the game, and that's always a great level, right? If you have skin in the game, if it's your money that's at risk, I'm simplifying, but you know, if your money's at risk, that you act differently, right? And then of course we, after the credit crisis in the US, we had the Dodd-Frank Act and everything, and things have certainly stabilized. But the point is learning the lessons from the credit crisis. It as my colleagues pointed out, it's not necessarily this massive explosion, but it could be more like an avalanche, right? This slow sort of thing, and as you know, a disaster that could be looming, and that, as I said, that's a perfect time to prepare and see what's happened globally, and then prepare, right? So what would we need to do in South Africa to prepare for that eventuality, right? And there's a couple of points there. Obviously, we would need more disclosure, right? There should be mandatory disclosure of private debt exposures. We've already got a lot of these things in place already, but you know, these mandatory disclosure of private debt exposures from pension funds and insurers, that's a great way of finding. So we know who holds what and on what terms and what maturity, etc. It's the lack of opacity, as it were, transparency. We need independent valuation. We shouldn't rely. I mean, this is always a good case, you know, who rates the raters type of thing. You need some independent valuation and validation where feasible, where it's possible. The rating of private debt, I mean, as we've seen, the incentive is sadly, but there are terrible incentives everywhere, right? And you have to protect against that sort of thing where there's potential conflicts of interest, and there are considerable conflicts of interest here. Right, verification, obviously, again, that's sort of under the umbrella of independent valuation and validation. Verify the underlying assets, right? See what the invoice book looks like. What are the maturities? What are the underlying loans? See what again. It's these things are all connected, right? It's about transparency, these things were all absent in the Enable Capital debacle, and as you've discovered now, well, that didn't end very well. And the oversight, that's always a good thing, and that's not a criticism of the SARB. We've got good oversight in South Africa. It could be better, but you know, it's pretty good. But you need that clear prudential authority over private debt, certainly in pensions and insurance portfolios, right? I mean, there's obviously an incentive to protect those and close that Regulation 28 discipline gap. That would be a start. And in the last panel there, you see that. So Enable Capital, it wasn't the crisis that I mean, that happened 18 months ago or so ago. It wasn't, you know, the bubble bursting and disaster, whatever. Disasters take a lot shorter time than 18 months in the financial world. But it was a warning shot, right? That's the way we should view it. It was sort of the red flag going up, be warned about this. So the window to build those guardrails, as indicated above, is right now. I mean, there's, as they say, that's always the best time, is like right now. And our market is in the early cycle, despite it being quite late to the party. And as Lena pointed out, that's not a bad thing in this case, right? The fact that we're lagging the developed economies of the world, that we can play that to our advantage, and we should still do that, right? That said, if we don't employ, you know, if South Africa doesn't employ these guardrails, the warning signs are all there, right? And capital is queuing to enter. The markets are moving at incredible rates. So the time to act is now, right? And so just some sage advice here. What every SA credit provider should weigh in. There's just some 4 generic sort of advice things here. So, and again, this reiterates what I said on the previous slide. There should be some independent asset verification. That's not negotiable. It's transparency. You have to know what's going on under the hood. And again, the enable capital lesson is there is that 700 million. It's not the global GDP, but it's a substantial amount, right? That move, there was no independent check of the invoice book. It's staggering to think that happened, but it did. What about the collateral? So, collateral existence should be verified, and quality, that needs to be confirmed through third parties. And self-reporting is never a good idea, right? And again, for those of you young enough to remember the case of I've forgotten his name now. Anyway, the guy who brought down Barings Bank, Nick Leeson, that was his name. If you remember the case, there was Barings Bank, 250-year-old, very prestigious British bank, brought down by Nick Leeson in the 90s. And in case you don't know, I'll give you a 10-second review. He was transferred to the Far East, where he was trading risky derivatives. And then there was an earthquake in Japan and things went crazy and he lost money. But before that happened, he was, and you can't make this up, he was the trader in the Far East. There were not a lot of personnel in the bank in the Far East. So he was the trader and he was the compliance officer as well. So he would do the trades during the day, take off his trader hat, put on his compliance hat, and check whether his trades during the day complied with the regulations. No conflict of interest there, right? So self-reporting is never a good idea for anything. Valuation discipline, honest volatility. So absolutely, these things all sort of feed into each other. There has to be this move from appraisal-based to independent, market-consistent valuation of these things. Liquidity structure, again, in the light of transparency. We need to match redemption terms to the underlying asset liquidity. If we don't match that up, banks know this very well. If these illiquid loans are wrapped in a liquid vehicle, then that's a way of protecting against that, right? Don't promise liquidity if you can't deliver under stress. And stress always arises. As someone said the other day, God forbid there could be a COVID-20. COVID-20, yes. Forgot what the original one was. COVID-20 looming. Anything could happen, right? There's a lot of turbulence in the world. You just have to look to the north in the Middle East and Ukraine. Whatever. There's a lot of crises that could happen, and these things could trigger. And then finally, manage concentration and counterparty governance, right? Single name sector limits, monitor those sort of things, and just better due diligence and ongoing monitoring. And again, enable capital's investors, they had the policy, they just didn't execute. They didn't know what was going on. There was this opacity going on, and so they all probably knew what to do, but it wasn't done, right? As long as the music's playing, everyone likes to keep dancing. So I think that's the last slide. And I'm going to hand over to our CEO to, sorry. I can skip that. So, Paul, if you're on the line, if you can just give a little bit of a brief background of Riskworx.
Yeah, thanks, Ben, Leila, and Gary. It's interesting, to see, how we kind of don't learn from our lessons of our past. The financial crisis, and subsequent regulations, unfortunately, have made lending to SMEs so much more difficult. And we know that the SMEs are the lifeline of the South African economy, and access to capital is vital for them to kind of grow their business, for us to grow our economy, and to grow employment for that matter. So I think, the message is, we need private credit. I don't think it's going to go away. I don't think it's a bad thing. It's just something we need to kind of be mindful of, do it responsibly. And yeah, it's about protecting our investors. So yeah, I just wanted to close out with that. There's a list of kind of services that we provide here. We've been working with a number of clients on these kind of independent valuations. So we're not a credit rating agencies. We have no intention of becoming one. But what we do play in terms of a role is on that independent valuation side. So yeah, thanks guys. And if there's any questions, please raise your hand.
Jenny, if you're on the line, just remember we're in presentation mode, so we can't see if hands are up. I don't think. So if you could just feed that through if there are any questions.
Hello, Gary. Yes, just to confirm to the team, we haven't had any questions in the chat. And at this stage, no one's raised their hand. I think you provided a very comprehensive presentation for everybody. But we do have
There's a question, Jenny.
Yes, I see it. We do have a question here. Gary, you did model validation at Fitch. What's the most common blind spot you saw in credit models for instruments with no real secondary market to check the model against?
Sure, that would be proprietary information. No, that's a good point. Sure, I don't know. Yeah, I mean, this is one of the problems why we get these bubbles forming. But what can I say? Besides a generic sort of, ongoing vigilance and opacity, transparency, that's always the sort of bottom line, right? The more transparent something is, and the more it's regulated. Sadly, all this bureaucracy, but the more something is regulated, and you have checkers of checkers, if you see what I mean. Remember, a rating agency, it used to be pretty much the final arbiter of assigning a rating, right? And now there is an agency, I've forgotten the name now, which checks how. Is our microphone muted?
No.
No, you can hear me. There are now, who rates the ratings, rating agencies, as I said. There are now independent assessors of what the rating agencies are doing. So as long as that transparency is there, I think that's probably the best protection against it. That's the best advice I can give at this stage.
Okay, thank you, Gary. We have another question. In your list of priorities and guardrails, is establishing a standardized private credit valuation benchmark on that list of 4?
No, it's not. But that's a very good point. That would obviously benefit the whole market, right? Establishing some sort of nationwide benchmark. Yeah, that's a good idea. We can add
so
that to
it
the
goes
list.
on to read, and if not, does that get built bottom up by the market, or does it need to be something like a CISA or the FSCA to mandate it top down?
I would say the latter, definitely. I mean, because it's not being done at the moment. So it doesn't exist at the moment. I think that's a good idea. And getting a bit, to hope that the market will just sort of self-regulate is too much to hope for. But yes, if a CISA or whatever mandated it, obviously if there's like a regulatory directive, then we would quickly get that sort of thing. And I don't think it wouldn't be too difficult to set up. So yeah, thank you for that. That's a really good idea. But it's not in place at the moment. As far as I know, not in place at the moment.
So just the comment to your answer is you are right. The key is transparency, but that seems contradictory when we are speaking about private credit valuation.
Yeah, well, that's the situation at the moment. But if the bubble is not to continue expanding and eventually burst, this is my opinion now, is that we have to have some transparency. There'll have to be some regulator that steps in and says, like is happening in South Africa. We pretty, advanced in that respect, and just say, listen, even as Leila was saying earlier, whether if you get a AAA rating from a Fitch, I shouldn't choose my, Moody's, whatever. If you get these AAA ratings from them or some mom and pop shop down the road, they are currently, certainly in the US, it's the same. It's great. Doesn't matter where it comes from. And that just can't be, right? Any sensible market player, it's completely non-sustainable. There's no, we went through the whole details of why that is a bad idea. So I think once it's mandated, it's just the flick of a pen, right? I mean, there's rules which, you need a regulator to step in and say, this is not happening anymore. And it'll be for the global good of the financial system. So I agree. It is a contradiction because of what's happening with private credit, but it has to change.
Yes, so I don't think it is really the way we want to go. It wouldn't be a contradiction. So we're not saying that the asset class should change in any way. It's just being more transparent about what is held. So if you are holding very risky loans, that's fine. The investor just needs to know about that so they can make informed decisions about whether they want to invest or not. So I wouldn't really call it a contradiction going forward.
The final comment was 100%. I see what you mean. Thank you.
Thanks.
Thank you for that interaction. Anybody else with any more questions for the team? It looks like that's all for now. So we really appreciate everyone who participated and attended our RiskPulse this afternoon. Thank you very much to the team for your concise presentation, and we appreciated the input there with a few questions at the end. So wishing you all the best, and we'll keep you posted for the next one. Thank you, everybody.